Stocks were mostly lower here on Tuesday as a result of what we saw in the communication services sector. Specifically, Snapchat got snapped nearly in half. They were down 43% here today, and that then caused a mass exodus from a lot of the social media names, whether it was Facebook, whether it was Twitter, whether it was Pinterest. They all got hit hard. Even Google got caught up in this sell-off, in addition to a number of other internet and tech-oriented names. So it was a tough day from a market cap perspective. However, underneath the surface, we did find a number of areas like consumer staples and utilities that did handle today's pressure nicely, and many of them actually closed higher here today. So it's a bit of a haves and have-nots type of a market. So we'll take a look at all of that and see what it means for our postures, and then we'll get into our trade application example tonight, where I wanted to focus on a big blue chip bellwether type of a dividend growth company that is approaching an attractive level for long-term ownership, where I'll show you how to sell a put on it as a result of some oversold cluster signals and some additional volume profile information. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 24th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you're signed up for our email distribution list, which you'll find in that description area. We're also heavy users of Twitter. My handle is @BrandonVanZ. Appreciate all of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and get started here today. And as we do, I just wanted to make a quick comment about the news I just heard. Unfortunately, another school shooting there in Texas, and hearts and prayers go out to all those that may be affected there. Just, oh man, that's a gut punch, I tell you. I'm a father of a 7-year-old myself, and it just, boy, does that put you in a different mood after hearing something like that. Happened to be going to an elementary concert myself tonight, and so I can't imagine what the parents are going through there in Texas. So anyway, I sure hope nobody that listens to this video was involved in that, but if so, our hearts are with you. As we get started here on this day of trading, you can see we had about a split difference here between the bulls and the bears. I would say that today was a day where the dividend investors kind of won the day out again. Some of you might have seen my post here on Twitter just a moment ago where I said, hey, we got some long lower shadows today, similar to what we did the other day, which is a good sign. You want to see a little bit of a flush out take place and then closing nearer the highs of the day in some indices, but it wasn't the exact setup that we are desiring here at this point, because as we'll see here in just a moment, the Dow Jones was the only one of the major equity indices that closed higher, and also the dividend ETFs also closed higher, DVY and NOBL as just a couple there. And as we kind of look at the breakdown underneath the hood of the market here, that should make some sense. As you look at where the green is showing up today, notice it is over here in kind of your consumer staples, energy, utilities, that sort of an area. You even had some healthcare stocks, off to the left-hand side doing pretty well. Most of those pay a dividend. Almost all of your consumer staples pay a dividend. Almost all of your utilities pay a dividend. And so it did seem like today was a day where investors were kind of seeking out, cash flows that maybe had been thrown away a little bit too ambitiously here in the last week or so. Remember, last week we had the big scare from Walmart and Target, and so a lot of dividend stocks were just tossed to the side, sell first, ask questions later, the type of mindset of the market here. So today was a little bit of a rebound for those, which, it's great for a dividend investor like me. I'm happy to see it, but I also will be the first to tell you it doesn't mean a whole heck of a lot for the market at large. What we really need for the market at large is for the largest cap companies to pull their weight. And today you can see that did not happen for the most part. You saw that Apple was down today about 2%. Microsoft was down about 0.5%. Alphabet was down about 5%. Facebook/Meta was down 7%. Amazon down 3%. Tesla down nearly 7%. Nvidia down 4%. These are the big players in the market, right? And when they're all down like they were here today, you're going to have a hard time making any progress at the index level. Now, for those of you that didn't hear, the reason behind this difficulty that the tech and communications areas were dealing with here today was as a result of Snapchat, not an app I'm too familiar with, as I'm more of a Twitter guy myself, but Snapchat is maybe for the younger generation and is a social media player, and really got trounced today. It was down like 40% today. And, it wasn't that they are that important to the rest of the market, but I think it's what they were saying that was important. And they were basically saying that the advertising environment has weakened considerably within just a few weeks' time here. So that ended up hitting a lot of those other players out there, like an Alphabet, right? Alphabet does a lot of advertising through its search engine, and even Amazon does more advertising than you might understand at first blush with their platform. So it did seem to have kind of a ripple effect through the most important players within the market, which is why we couldn't really see a whole lot of good progress here today. So let's go ahead and pop on over here to the main part of the platform now. And as you can see, we did have lower markets for the most part, with the exception being the aforementioned Dow Jones Industrial Average. It did manage to close in the green just barely by 0.15%. So in other words, just a tad above break even. The other markets, the S&P 500 was down about 0.81%. NASDAQ Composite was down 2.35%. and the Russell 2000 was down 1.56%. The Nasdaq was down 3% at its lows during the intraday period, and I do know that the S&P 500 was down over 2% while I was in class earlier this morning. And so you did have some pretty decent rallies from the lows of the day. And again, going back to that comment about long lower shadows, these are not the longest lower shadows that you will find. We did see much more important looking lower shadows on Friday's candle. Some of you saw me tweeting about it that day as well. And one of the things I was pointing out is it's nice to see both the long lower shadow today and also on Friday, but we are lacking in the department of volume. Let me just step away from the foregrid here for a second. Come on over here to chart 3A, and I'm just going to pull up SPY, which is usually a pretty good proxy for whether there is good volume taking place or not. Remember, it's not exactly the same as SPX as an index that's not really traded, but SPY can be a proxy as an ETF to try to get a sense of whether there is interest in trading the underlying index. So down below here, you will notice that our candles recently do not have a black arrow in them. Like over here, notice that we had, about 6 out of 7 trading sessions with that black arrow showing up, which basically means that we had 1.5 times our typical volume on those particular sessions. Now, fast forward to where we're at right now, we're all kind of just waiting around for some sort of a snapback rally. It seems like it's taking longer to manifest itself than what a lot of us had desired. But when we have a long lower shadow like we did on Friday, that's at least a start. But the problem is, you can see down below here, it was not 1.5 times your average volume. That would have been the case if this bar down here would have come up to this gold line, which we still had a lot of separation there. And today was even worse. Now, Friday was a little surprising to me, and in my tweet itself. And again, hopefully you guys are following both myself and David on Twitter as we try to teach you in between our presentations and classes as well. But one thing I mentioned on Twitter on Thursday in regards to the long lower shadow and the lack of volume is it was particularly surprising given that Friday was an options expiration day. A lot of times you have a lot more aggressive trading and volatility and people repositioning their portfolios into the weekend and all that kind of stuff. And even that did not have as big of an impact as you would have assumed. So we're still left kind of wanting more. Unfortunately, I guess is the long and the short of it. We have some initial signs that rally attempts are being made, but they just haven't been robust attempts. And so it kind of gives you the impression that if this is all the bulls have, it's going to be pretty easy for the bears to squash them a bit further. Now, if that all changes and we have some sort of a huge capitulation type of a day, where let's say the markets are down 3 or 4% in the morning and they come rallying back and close in the green, you have huge volume associated with it, then you get the impression that, hey, there's actually a flushing taking place, and that can be constructive to work off of, to have some sort of a counter trend type of a move, at least in the short term. Again, my fear is that while I expect to have some sort of a counter trend move in the short term, I do not at this point expect that to be a trend changing move. I do not expect us to be back to all-time highs at any point during the summer. I could be wrong, and I hope I am for my own portfolio's sake, but that is not how my mind is thinking right now. And so we just haven't seen that type of behavior yet. And right, we've also talked about the VIX endlessly. And you'll notice that despite the markets being down today, the VIX didn't really have a robust effort there either. Yes, the VIX was up on a day when the markets were down, but the VIX was only up 3%. Now, I know you don't really quote a percentage on a percentage, but just to give you an idea, that is not a very big move for the VIX. You can see what that candle looks like right there on the VIX. And, we had traded a bit higher earlier in the session when the markets were selling off a bit more, but we effectively closed right where we opened on the VIX here today. And we are still a far cry away from where we were trading exactly 3 months ago on the VIX. Now, again, think about that for a second, because if I were to pull up the S&P 500, the S&P 500 is trading way below where we were trading 3 months ago. Yet the VIX is still lower at this moment in time than it was back here. So typically that should not be the case, right? The lower the market goes, the higher the VIX should go, all else being equal. But we are not seeing that this time around. Markets were more concerned 3 months ago, even when prices were higher, which is a bit of an oddity there. So a lot of folks are not just waiting for a long lower shadow with heavy volume, but also a spike in the VIX that comes that day that could hopefully get us closer to 40. Right now, the VIX, as you saw just a second ago, let me go back to it, the VIX closed below 30 here today. Right? That's not the sign of intense fear. We would need that closer to 40. In fact, 3 months ago, we were up there at 37. So that's at least a better effort. But it'd be nice if this were going to be a significant low of some sort for the VIX to spike to 40. Now, of course, in order for that to occur, something really, really terrible has to happen within the market. Maybe we need to lose a big leader like Apple going down over 10% in a day. Or something along those lines. Maybe the entire energy sector that has been kind of carrying this market this year needs to unfold 10% in a day. There's got to be some sort of a major violent event and then some sort of a snapback before market participants are going to trust any rally attempts at this moment in time. Now, back to the major indices here. You can see that we remain with strongly bearish postures with these charts. In fact, remember, we talked about the other day how the Russell 2000 had been kind of going back and forth from bearish to bullish. That continues to be the case. Yesterday, it was bullish, weekly bullish. Remember, when the green line is rising between 20 and 80, it's weekly bullish if it's not yet above 50. So in other words, from 20 to 50, if it's rising, then it would be a weekly bullish posture. If it's above 50 and rising up towards 80, then that would be a strongly bullish posture. So even yesterday, it was just considered a weekly bullish posture. Nonetheless, it was at least some signs of, strength there, where you're trying to, find that opportunity to seek out that evidence. But here we are just one day later with the Russell 2000 down 1.5% today. That green line rolled back lower again and is back to close to the lower reversal zone. Remember, the lower reversal zone is at 20 on the market forecast, so we're not quite there, but because it's falling towards the lower reversal zone, we still consider that to be strongly bearish. So with the other indices, it's a little bit of a different setup because they've all been in this strongly bearish posture for several weeks at this point. Russell 2000 was kind of giving us a little bit of hope that it wanted to kind of break that philosophy and start becoming a leader to the upside. But, even if they are able to accomplish that on a relative basis, it still would not be overly noteworthy until they can actually start trading above their moving average. Right, and it seems like we've got a lot of work to do before we get there. Now, there's a lot of extreme technical analysis readings. All you have to do is go onto Twitter, and you'll find lots of those, including 7 weeks in a row to the downside for the markets, which throughout history there's only been a couple of examples of 8 weeks in a row. So if we're down again this week, we'll match some of the longest streaks from a time perspective to the downside. And of course, we've had oversold cluster signals and this, that, and the other thing. There's a number of things that you could kind of get behind and think, boy, we could really start some sort of a bullish move from here. But it just seems like everybody's waiting and everybody just walks away day after day, just not quite satisfied with what we're seeing. And that includes, the Russell 2000, where we have a little bit of hope that, hey, things are maybe trying to turn around, but it just cannot get the traction it needs to even come up and touch the moving average, let alone surpass it and stay above it. So not a great look towards the markets here today, despite the long lower shadows. So strongly bearish postures on all 4 of these key U.S. equity indices. All 4 of them remain below their falling 30-day moving averages there as well. Let's step away here and check out the internet briefly. I always like to say thank you to those of you who help support this market outlook presentation. Remember, David and I do not get paid to do these videos. We do them out of our own goodwill, and our hope is that you guys are more educated by listening to our analysis, and then of course we do hope that at some point some of you will become premium members of our organization where we do make money. But anyway, in the meantime, even if you're at a different budget level and you can't quite afford to be part of our program, we sure would appreciate it if you could click like for us there to continue these free videos for you as we move along as well. So thank you to the 105 folks that clicked like for me the last time I did the video. Remember, anytime we're up and over 100 likes, I'll plan on doing a full-length video the next time around. So that's why we're doing it here. And that includes a trade application example. If we're under 100 likes, then I kind of get the sense as to whether these videos are worth your while, right? Obviously, the less you guys are willing to click like, the less motivation we may have to continue them at the current rate as well. So do your best on that count. I know many of you commit to doing that each and every night, whether it's David or myself doing the videos, and we certainly appreciate that. So thank you to all 105 of you, including James and Nick and DGI and Options and David and Chris, HR, Tom, Ayakipa, Tao, Eileen, Ken, Joe, Jim, Fresh Trades, Valerie, Rom, Claire, Gerald, Ed, Carl, Michael, John, Norm, Glenn, Kirk, Dale, Adrian, Rick, Dave, Paul, Linda, Margie, Sonia, William, Alejandro, Dave, Ann, Dave, Serene, Austin, another Dave. Too many Daves, right? As a parent of a 7-year-old, I've, of course, read a little bit of Dr. Seuss in my day, and so we get a kick out of the Too Many Daves book there. But we actually appreciate all of our Daves here, and I suppose that is apropos, as my business partner's name is Dave as well. So thank you to all the Daves and all the rest of you who were willing to take 5 seconds out of your day to click like for me the last time around. Please keep that up. Also, while we're over here on the internet, let's take a peek here at the Sector Selector tool. A reminder that this gets updated on Friday evenings. And just a reminder here that this is an equal weighted approach that I use here, not a market cap weighted approach. And it uses 3 different time periods, 1 month time period, a 3-month time period, and a 6-month time period to kind of spit out rankings to give us an idea for my Monday top-down trend trading class as to which sectors are giving us strength versus weakness on a relative basis. It helps us apply trend trading techniques for that class's portfolio that we manage. And so at this moment in time, probably not a surprise to see that energy remains number one again. Probably sound like a broken record this year, because pretty much every week this year it has been the case that energy has been up there at the top. You can see that they have a clean sweep all the way across the board, meaning that on this 3-month rolling graphic where I lop one week off, that's the oldest, and add the newest, that it's been number one the entire 3 months that you can see here, and it would have been number one in all of the weeks that you don't see prior to that as well for several of the weeks prior. So no change at the top. Oil and gas stocks are still where it's at. It's oil and gas's world, and the rest of us are just living in it. On the downside, you can see that consumer discretionary finds itself dead last. Ugh. And judging by what we see out of Target last week, judging by what we see out of Amazon today, and a number of the other retailers that have been reporting, no surprise that they have struggled here and are at the bottom of our rankings in that case. Now remember, Snapchat technically is a communication stock, so knowing what we know at this moment in time, now keep in mind the week is young, it's only Tuesday, but knowing what we know right now, I would not be surprised at all if we see a switcheroo between communications and financials here in the coming week when I do the next rankings. Some of you have seen me tweeting about JP Morgan here recently. If you hadn't, here's what I was tweeting about this morning regarding JP Morgan, because I was tweeting back here at the end of April about how JP Morgan was going into the blue zone on the dividend stair-step chart that we use in my dividend growth investing classes. And so, I just kind of shared an update to that, letting folks know that this is the type of behavior we are looking for out of a company like JP Morgan that got too hot and became overvalued up here in the orange zone, fell back to a more reasonable valuation in the blue area here, where maybe it would have been appropriate to pick up that stock at an appropriate yield, and now we are seeing it exit out of that blue zone. Now, how long it stays out remains to be seen, right? Back in the COVID time period, you can see it stayed in the blue zone for quite some time. It had an attempt to get out of it and then fell right back into it. And if we have a tough market in front of us, it's entirely possible that happens again. But just wanted to point out that this is kind of what you're hoping for, right? You're hoping to wait, and then buy. And then as soon as you do, hopefully have the stock emerge out of those kind of oversold territories there as well. And so that was some really good behavior, because just last week, JP Morgan was trading down here at about $116, $115. And here we are $10 per share higher in just 1 week's time, while the rest of the market has been struggling to some degree. And so judging by what I see out of JP Morgan this week, and then judging by what we're seeing out of Snapchat and the other social media companies here today, I have a sense that there is a strong possibility that communication services and financials may flip-flop their rankings the next time I do them. But we'll all find that out together this coming Friday evening. So again, it's kind of the same batch. You got your defensive and commodity-oriented areas controlling the top rankings. You've got your more compounding growth areas down there towards the bottom. One final thing that I would add is that I did see a continued improvement out of technology, which is a good sign. Now, that didn't really help them today. Again, Apple being down today, Nvidia being down, etc. But at least what we've seen up until this week is a slight improvement on a relative basis of technology compared to what we've seen in some of those other areas. So at least one tiny itsy bitsy little bright spot, whether it's noteworthy enough to actually lead to a significant change moving forward, remains to be seen. We have to be honest with ourselves and remind ourselves that technology is still in the bottom half of the rankings. It's just not dead last like it was back here on April 15th. And remember, technology these days is incredibly important. It's one of the most influential sectors out there in this current era. All right, let's go ahead and pop back on over to the Paper Money platform. Also, a quick reminder that I taught my dividend growth investing class earlier today. That recording is now posted up here on our Trading Rooms calendar, and the same goes for David's directional option strategies class. So if you're a premium member, feel free to check out those recordings if you're looking for some additional content. All right, let's go ahead and take a look at some 12 grid analysis now, starting with chart 5A. This is our asset class 12 grid. And as you can see, we do have a slight improvement here, right? And that's kind of the second time in a row I've said that, right? About a week ago, we had way more pink than green charts. And it's still plenty of pink charts out there, but kind of slowly but surely, we're starting to see a few more of those green lights turning on, which I guess is progress. It's not huge progress, but at least it means that some areas of the market have stopped just completely getting decimated. And so let's talk it through here. First of all, the only dark green chart on the board remains oil. So this is a barrel of oil here. We're using the proxy of USO, but in general, it gives you a sense of where the trends are for that particular financial entity. In this case, a barrel of oil is obviously strengthening as time goes on. It's up about 20 to 25% over the last 3 months. And it does seem like the path of least resistance continues to be to the upside. You guys might have heard me mention that over here when it was breaking down below that moving average. I said, let's not get too aggressive with our thoughts here that all of a sudden we're going to have a big breakdown in oil. Because every time we might have thought that, back here and back here and back here when it crossed the moving average, was a time to buy, not to sell. And one should know, of course, that's exactly what happened. This was more of a buy day than a sell day, and gave you an opportunity to buy it at a cheaper price. So when something is clicking and in a trend, that's your trend. It's your friend until the end, as they always say. And until we start seeing legitimate broken support levels over and over again, you have to assume that an entity that has higher highs and higher lows across the board is going to continue to drift in the direction in which it came. And so oil remains in favor, no matter how much people want to fight against it and think it shouldn't be up at where it's at or whatever their thought is. The truth of the matter is it's one of the only areas kind of quote-unquote working within this current market in 2022. So that is our strongly bullish posture. Now, when you look at these other green charts here, they're light green, telling us that we have weekly bullish postures on those. So, in other words, there has been some buying pressure on them recently, but they're not to the point of being, game-changing, trend-changing types of behavior yet. Obviously, if there is going to be a change of trend, it's got to start somewhere. So the hope is that it starts with a weekly bullish posture that leads to a strongly bullish posture. But right now, we'd be jumping the gun if we assume that was going to happen, largely because out of these 4 light green charts here, only one of them is trading above its moving average, and even that is just barely. We did have some positive activity here out of long-term U.S. Treasuries, and notice that we did have a change of color on the 30-day moving average. It changed from red to yellow, letting us know the conditions have changed. In this case, what changed is that the moving average is still going lower, but price closed just barely above it, probably only by a couple of pennies. Nonetheless, it's a start. With these other 3 light green charts here, all vertically stacked, notice that their moving averages remain red in all of those cases, telling us that price is still below a falling moving average, and therefore you should assume that the path of least resistance continues to be to the downside. So that includes foreign developed stocks, foreign bonds, and gold. All of those have weekly bullish postures, saying that, hey, we've had some decent rebounds here off the lows a week or 2 ago, but we're just not to the point of being able to say that they're strongly bullish quite yet. Another thing that I would point out that I did mention maybe a week or so ago, for those of you that were listening, is that there is the potential for the 10-year U.S. Treasury to have a head and shoulders pattern. I don't hear a lot of people talking about that, and so that's something that, of course, I wanted to share with you since it was on my mind at the time, and it continues to be the case today, so I'll point it out again. But if you were to kind of squint a little bit, remember these are never textbook examples, but nonetheless, you have a left shoulder here, you have a head here, and you have the makings of a right shoulder here. And if it breaks down hard, you could actually have a legitimate reversal signal setting up there. And remember that yields and bond prices work inversely to one another. So same thing over here where you're getting kind of the opposite mindset. In other words, you have kind of a left shoulder there, a head, and then a right shoulder. It's again a bit sloppy, not exactly a textbook image, but that would be the opposite of that, known as an inverted head and shoulders pattern. It is also a reversal pattern. So keep your eye on that possibility. Now that's going to have both good and bad consequences. Remember, for the longest time, especially after the NASDAQ started rolling over in late November and into the beginning of this year, it seemed like one of the greatest reasons or excuses that the market was applying to the move lower in tech stocks was that interest rates kept on going up day after day after day, as tech stocks are kind of thought of as almost long-dated securities. As you're discounting their cash flows back, they have a higher hurdle rate when you input a higher interest rate calculation. And so that was a big talking point for several months there. And so you might be thinking to yourself, well, wait a second, now that we're actually seeing a bit of falling interest rates here, shouldn't that be good for tech stocks? And the truth of the matter is, the fear at this point is that there is now an interest in going into U.S. government bonds because the stock market is running scared right now. And sometimes that happens when bonds become more attractive than stocks, all else being equal. Right? In the past, you used to hear the acronym TINA. There is no alternative because bond yields were so low. But with bond yields having gone all the way up to basically 3% here just a week or so ago, there is now an alternative. And that might actually start attracting buyers. Folks might be switching from stocks into bonds as a result of that trade-off effect and the fear in the overall economy due to inflationary pressures and Russia, Ukraine, and monkeypox and everything else you're going to throw out there to scare investors at this moment in time. So, we finally saw a little bit of give back in interest rates, and I think a lot of tech-oriented investors were hoping that would be a boost to tech shares, but the reason that they're switching over might be impacting why that's not actually happening at this point, right? Maybe it's just a delayed effect. Maybe that will happen later, but right now we're just not seeing that quite yet. I think we're seeing a run towards U.S. Treasuries because market participants are fleeing the risk that they perceive in the stock market, which is more of your traditional relationship. Remember, what we saw at the beginning of this year was anything than normal, right? The idea of both the bond market and the stock market collapsing at the same time is almost unheard of throughout history. But that's what we were seeing this year. So it was very peculiar. Usually when the stock market gets trounced, money does rotate into the U.S. Treasury market much earlier. So maybe we just had a little bit of a delayed response to that, but we're finally starting to see some folks take an interest in those long-term U.S. Treasuries. And of course, we've had endless amounts of oversold clusters to kind of encourage folks with U.S. bonds as well. But it's kind of one of those delayed reactions, it seems, more than anything. Now, in terms of the other charts, they remain pink. And of course, it's the two corner charts that were the most consistently green for most of this year that are now both pink. So there's a little bit of a kind of a different feel to this market all of a sudden. I already addressed the U.S. Treasury yields falling yet again today, and the 10-year now finds itself at 2.76%, down from above 3% just a couple of weeks ago, and now below its falling 30-day moving average, in addition to having a strongly bearish posture. U.S. dollar is a bit peculiar as well. Remember, we had this epic move in the U.S. dollar where it was up 6 days in a row in almost a straight line. And then it kind of consolidated for a little bit, and then you had one last burst of energy that resulted in overbought cluster signals, right? Those two red dots on the chart are overbought cluster signals according to the market forecast. And then we had this significant push lower in the U.S. dollar. We now find ourselves below the 30-day moving average. Now, the difference here versus the difference over here with Treasury yields is, notice that the colors are different. Over here, I mentioned it's red because price is below the falling moving average. On the US dollar, we're trading below the 30-day moving average, but the moving average is still rising, so that's why it's yellow in that case. Now remember, the longer it stays below the moving average, eventually that'll wear and tear on the moving average, and it will roll over as well. So you're kind of at a little bit more of a make or break point on the US dollar. If it's going to establish some sort of a bullish bounce, you'd want that to happen sooner rather than later. We'll see if it's in the cards or not. We did have a little bit of a rise out of Bitcoin today, not much to speak of there, only up about 1%. High yield bonds actually had a pretty good day. They were up 0.6%. You can see a nice looking candle there on the high yield bonds chart, and that might have been as a result of oil prices being up there a little bit as well. But that's probably a good sign. Remember, out of the different bond market areas, you want to see the junk bonds doing well as a measurement of risk-taking appetite out there. And so when we do see high-yield bonds up, even though the stock market was down today, that's a slightly better feel for it than it would be otherwise. There's not a wide fear of mass defaults that's taking place on the corporate side of things yet. We're just in a little bit of a malaise in the corporate environment. We're not in some sort of a panic mode where the market assumes that all these corporations are going to start defaulting on their debt yet, right? We don't know. It could get there later on this year or maybe next year, but right now there's not that perception quite yet. So there's not extreme readings from that perspective. I mentioned before that foreign developed stocks have a weekly bullish posture here. They were only down 0.16% today. Foreign emerging stocks were down more violently, down 1.74% today, as it seems like those Chinese tech stocks kind of have a little bit of hyper movement built within them, depending upon what the NASDAQ does, right? Even Alibaba and Baidu and JD.com and Pinduoduo, those companies are based, at least their ADRs are listed within the NASDAQ. And so when the NASDAQ has a tough day like it did today, you might find that the emerging market stocks led by those mega cap companies in China are going to struggle on a relative basis there as well. Preferred stocks had a pretty nice day. They were up 0.5% there. And so not too much to read into it because we still have that strongly bearish posture there, but it was a pretty nice day nonetheless on preferred stocks. And sometimes you do find that they move in alignment with banks like JP Morgan that I had mentioned before, as a lot of the companies in the United States that issue preferred stocks are financial companies. All right, let's go ahead and take a look at our next 12 grid here, and this will be our Sector 12 grid, chart 5C, for those of you following along at home. Now, as we pull this up, you'll notice there on this 12 grid, there's also only one chart that has a dark green background color, and that is energy. Again, no surprise given what we just saw a moment ago on the Sector Selector tool. Everybody who has doubted energy this year has lived to regret it. Energy has been one of the only places that has consistently been a money winner on the long side of the equation for traders and investors this year. So it was another nice day for energy, up 0.38%. We actually just bought another oil company in my top-down trend trading class yesterday, and we already had 4 other oil companies along with an oil stock ETF in that top-down trend trading class, where we sometimes trend trade ETFs in addition to individual stocks. So we've had an above-average exposure to energy this year in that class, mostly because there hasn't been a lot of other places to look. And so we are thankful for that exposure. Even if it doesn't fully offset the losses of all the other sectors out there, it is nice to know that there is some strength within the market. So they did reasonably well here today, up 0.38%, maintaining their strongly bullish posture, and is the only sector that has a green moving average. In other words, price is above a rising moving average. Now, speaking of moving averages, I can at least add one more slight bright spot on that conversation, and that is with the utilities. Last week and the week before, I was talking about how energy was the only sector that was above its rising or above its moving average, rather whether it was rising or not. This week, I can't get away with saying that because there is a new entrant here, and that is utilities. Now, as you can see with this utilities chart down below, it does not look as consistent and persistent as the strength we've seen in energy. But at least we can now say there is a second sector that is trading above its 30-day moving average at this moment in time. The problem is the moving average itself is pointing lower. So it's not as good of a trending looking chart as what we see with energy. Nonetheless, again, we've got to start somewhere. If there is going to be an eventual nice looking trend, then that trend has to start somewhere. And who knows? You just never know when a trend will start. But maybe this is the start of an ongoing move in utilities. Remember, we actually had a pretty good move out of utilities around here. We still own, I think, 4 utilities in my top-down trend trading class from that era. When it was in a pretty significant up move there as well. But it kind of gave back a big chunk of that as the markets have been bearish, stabilized a bit below that moving average, and then with this last 3-day rally, remember we've been up 3 days in a row now on utilities. Today was a really impressive candle. We were up 2% on XLU. Remember, the utilities are one of the calmest sectors out there. So to have it go up 2% in a day when the stock market was down is really saying something. That was an aggressive move higher there in utilities. And there's been a number of utilities that still have decent looking trends out there as well. So that would be kind of, your honorable mention hunting grounds after energy if you're looking for strong trends out there. And then we've got healthcare kind of in the lower left-hand corner. Now, as I mentioned before when we were looking at the sector selector, healthcare is not scoring as well on the sector selector as it shows up here on this 12 grid. And the reason for that is on the sector selector, like I mentioned previously, I use an equal weighted approach. This is the market cap weighted approach here with XLV. And some of you saw me tweeting about Merck over the weekend as just one example of a large or mega cap healthcare company that is just dancing to its own tune. Take a look at MRK here, and that chart just looks as though there is no concern in the world, right? It's the type of chart that you would see in the midst of a robust bull market. Yet we are in one of the worst markets that we found ourselves in here in years. And this is the way that Merck's chart looks. So as a result of Merck and a handful of other major pharmaceutical companies, you are finding that XLV, the healthcare ETF, is able to at least have some semblance of strength. I still don't think this is a great looking chart. You're still below the falling moving average in this case. But again, you got to start somewhere. And who knows where this could lead us later on in the summer. You did have all those oversold cluster signals and having a nice response to that. So those are our 3 bullish sectors at the moment from a market cap weighted perspective. Energy, then utilities, then healthcare. Now, all the rest of the charts on the board are dark pink, not just light pink, telling us that we have strongly bearish postures on the rest of them. As mentioned before, we actually had a pretty good day out of the staples after last week's beatdown with the Walmart and Target news and that sort of thing. Staples today were up 1.64%. Real estate was also up nicely today, 1.17%. Remember, I put those sectors on the bottom rung specifically. It wasn't just a random accumulation of these charts when I originally put them together. And I wanted to put the more defensive sectors at the bottom. So today, again, one of the takeaways is, yes, it was good that we had the long lower shadow in the markets, but it was not necessarily good that we were being led higher by the defensive areas, right? We had healthcare up, we had staples up, we had utilities up, and we had real estate up. Now, other than energy, which just barely closed higher, all the rest were lower here today. And it's all the rest that are more important to the market's bullish fortunes moving forward. So we really need those other sectors to start pulling their weight here. And of course, again, today's big story, just to put a ribbon on it, was what happened within the communication sector with Snapchat just completely getting annihilated. Snapchat, by the way, was down 43%. That was its worst day in history. So it was not just a small miss. It was like a swing and a miss, where like a cartoon where they're swinging the bat at the ball and the cartoon wraps all the way around several times over and over again. That's how big of a swing and a miss that was for Snapchat, down 43% in a single day. And so that had a devastating effect on other companies like Facebook, that was down 7%, and then Google, which was down 5% as the bigger players within communications. And so no surprise that communications as a sector was down 3.5% here today. And of course, does still continue to have that strongly bearish posture there as well. All right, so let's now get into our trade application example. And for that, I am going to pull up chart 2A. And a reminder that the trade application example was already done while the market was open today. Today, I got the trade done a little bit earlier than normal, knowing that I had to kind of rearrange my schedule a little bit with the aforementioned elementary school concert that I need to attend tonight. So anyway, I had to do things a little bit differently today than I normally would. But I got the trade done about an hour before the market closed today. And at that time, the S&P 500 was down more than 1%. You guys know my style. When the S&P 500 is down at least 1%, which we've had a lot of those days lately, I am going to look towards the idea of selling puts on stocks that I want to own at lower prices. And so Intel is a company that we've been talking a lot more about here recently. Intel is a company that, of course, is a Dow Jones Industrial Average company, a big blue chip bellwether semiconductor company. And as you can see from this chart 2A here, Intel has largely been going higher as the years have gone on. And that makes sense. Remember, technology as a sector has been doing quite well over the years. So you would assume that all else being equal, most tech stocks will be heading higher. Well, that has changed recently. You'll notice that Intel kind of put in a bit of a double top up here at around, I'll call it about 69 or 68 bucks, right? You had touch point 1, touch point 2, and then you've had quite the rollover since the highs early in 2021. And that's been the case with a lot of tech stocks. Now, you know, this is not a Netflix that's down 75% or something like that, but nonetheless, for a big blue chip cash flowing dividend machine like Intel, this has been a pretty healthy haircut. Now, for those of you that know how to read this dividend stair-step chart, you'll know that when you get up here into the orange area, it's what we dividend investors from the long-term perspective perceive as overvalued territory. Once you get down into the blue zone, it's what we long-term dividend growth investors deem to be more reasonable valuation, where we want to establish long-term positions moving forward. And you can see in Intel's case, prior to what we've seen here in the last couple of weeks, the last time we had touched the blue zone was back here in 2016. So quite some time ago, right? 8 years ago, or whatever it was, 6 years ago. So it's been a long time, right? And people have kind of watched it kind of take off, perhaps without them. Some folks might have bought it back here. We were actually buying Intel back when I worked for TD Ameritrade. So some of you who have been to my dividend classes over the years, maybe some of you still own it from those days. But I would venture to guess that most of you who have been in my dividend classes in recent years probably do not own it, or if you do, it wasn't due to the rules that I teach you, because I teach you to wait until it comes down to the blue zone. And so as you can see, it's been a long time coming, but finally we've had enough pressure in the market to even force a giant like Intel into our crosshairs. Now, where it closed here today was at $41.67. You can see in this blue label up here at the top that says AHY price, which just stands for average high yield. You can kind of see that in this other blue label over here. So average high yield price would have to be 41.48 or better in order to achieve the average high yield of 3.52%. So in other words, where we closed today was slightly above this blue line. I know it's hard to see it with the naked eye, because with this being a 10-year chart, everything kind of gets skewed just a little bit there. But that's why the labels are there, to help you along with that conversation. So we're trading here at the close today about 20 cents higher than where we would prefer to buy it for the long term. And you can also see that with the yield, right? Right now in real time, the yield is 3.5%. We want to buy it with a yield of 3.52%. So the stock would have to come down in order for the yield to go up to the price that we want it for the long term. So when I have a situation like that, where price is a little bit above the blue line, I think to myself, would this be a good candidate for selling a put? especially on a day when the market was down over 1% like it was earlier here today, when volatility is higher, and therefore the premium that you receive is juiced more as a result of that volatility. And so one other thing I wanted to bring up, other than just the fact that this is the first time in the last 6 years or whatever it's been that it's touched the blue line, if you move this over to a monthly aggregation period, and I was already tweeting about this over the weekend as well, so this is not new information for those of you that follow me on Twitter. Remember, sometimes if you follow me on Twitter, you might very well guess what trade ideas I might bring to you in these videos as well. But I was mentioning on Twitter that if you change the aggregation period from weekly bars to monthly bars, so I'm just going to come down here and click on 20-year monthly instead of the 10-year weekly that we're looking at currently. So when I do that, notice that at this moment in time, we have this little green dot appearing below the bar telling us that we have an oversold cluster signal using the market forecast technical indicator on a monthly candle chart, or a monthly bar chart in this case. Either way, it's the same thing. But that is incredibly rare for Intel. If I were to zoom in just in the time when Thinkorswim has been plotting dividends here, because Thinkorswim kind of got a little bit late to the game in terms of plotting dividends on their charts. I'm glad they did it eventually, but in this case, they kind of started back in 2006. So in this period where Intel was paying dividends the entire time and never cut their dividend. Now, they did have a 2-year period where they kept the dividend the same, right here where that blue line plateaus, back here in 2013 and 14. So their dividend streak kind of had to start over after that. Nonetheless, they never cut their dividend during that time period. They just kept it at the same rate. So this has been a pretty consistent and steady Eddie dividend paying company. Not even in 0809 did they cut the dividend. They did maintain dividends throughout all of the difficult periods we've seen, in the last 10 to 15 years or whatever it's been. But if you were to, pull this chart up on a monthly basis, we now have an oversold cluster signal on Intel's chart. Now, one thing I mentioned on Twitter, and I'll reiterate it here, remember, today is not the last day of May. So we've got to be a little bit careful not to count our chickens before they're hatched, because if Intel were to rally strongly between now and the end of May, which is only a week away, then this little green dot could disappear. If it stays at this level or worsens between now and the end of May, then there's a better chance that green dot will be retained. But to put some perspective into how rare this is, let me come up here and get rid of my dividend bubbles to make this a little bit easier for you to see. Notice that back here, we had this little green dot appeared right where you have the low tag that says $12.05. And that happens to be the month of February 2009. So in other words, the closing price of February of 2009, which was in fact within a couple of weeks of the bottom of the stock market during the great financial crisis. So that should put that into perspective. All of these other bars, every single one along the way, and remember, there were a lot of them, every other one along the way did not produce an oversold monthly cluster like we are experiencing right now. You had a couple of overbought clusters with these little red dots appearing a couple of times along the way when you were up there in that orange zone on those 3 different times. But this is only the second time in the last 15 years or thereabouts where we've had an oversold monthly cluster on Intel. The last time that it had it was a very attractive time to be a buyer of Intel. I think we all wish we could go back in history and be buying as much of Intel as we could for $12.05 back there in February of 2009. Will this be as good of an opportunity right here, right now? Probably not. We will probably end up having worse returns in the coming decade than you had off of those extreme situations there. Nonetheless, can this be a reasonable time to pick up shares at value territory, or do what I did, which was to sell a put? Now, one other point that I wanted to make, I had a student that I was working with talking about the volume profile, and I was mentioning that you want to kind of match up the volume profile on a longer term chart if you plan to be a longer term investor and making your decisions off of that. Whereas if you're a shorter term trader, then naturally you want to use a volume profile on a shorter chart because it's going to need the inputs in order to have a reasonable output. And so if you're trying to input short-term indications into a long-term philosophy, you're probably going to end up with a result that is not all that useful, or vice versa. So in this case, I also wanted to quickly point out that if I were to come over here to chart 6A and pull up Intel's chart there, and pull up a traditional 10-year weekly chart like we do in my longer term classes, notice that this volume profile does suggest that there is a healthy amount of volume right here, almost dead on the $35 mark. For Intel specifically. There was a ton of trading at that $35 level during this 3 or 4 year period back here from 2014 through 2017. So 35 from a volume profile perspective could also be somewhat interesting. And so that's what I ended up doing here earlier today. I sold the $35 put in the month of July. We got 42 cents for selling that, which I usually target the 1% return on risk area. And so in this case, we got a little bit more than 1% return on risk. But basically what that does then is it puts me on the hook for buying 100 shares of Intel at $35 per share if it does fall from the current $41 down to $35. So this is the type of trade that you would want to enact if you were wanting to be a willing buyer of the trade at those levels. Now remember, you can always roll contracts as well. In fact, that reminds me, we've been rolling the best buy contracts here both last week and again today. And so if you do sell puts and you decide that you want to roll them for credits, that opportunity does emerge as well for those of you that want to go that route. It depends on whether you want to take ownership of it and whether you've got the buying power and all that kind of stuff as well. But in general, I would say that $35 here at this volume profile area that stretches across a lot of this prior resistance and support area back here during this 4-year time period, along with the evidence that I showed you here a moment ago on the dividend stair-step chart, where not only are we basically sitting right atop the blue line on the weekly chart, but also have an oversold monthly cluster signal for the first time since 2009, that sets up a compelling argument that, hey, if you were going to have a counter trend type of a move where you're trying to be a little bit more bullish in a bearish market environment, then maybe this is one of those types of opportunities that you could explore and do so with a somewhat built-in mechanism for margin of safety, right? Because it's not like we're saying, hey, you're buying the stock right now by selling a $35 put. You're giving yourself a little bit extra wiggle room there as well in the coming couple of months, okay? So that's what I had for you here tonight. If you enjoyed that explanation of this trade and some of those different technical indicators and things that are catching my eye, I appreciate it if you guys just simply do one thing for me. Take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video for you the next time around. So, until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.